Welcome to the Luca Ledger.
Welcome to the Luca Ledger with Brett C. Arnold, CPA and president of Luca Financial. Brett works with entrepreneurs and small business owners to help them understand their numbers, reduce unnecessary tax burdens, improve cash flow, and build more profitable businesses through strategic financial planning and fractional CFO guidance. I'm Evan Mack, and today we're talking about the difference between tax planning and tax preparation and why so many business owners end up paying more than they need simply because they wait too long to think about taxes. Brett, welcome to the show.
Hey, thank you so much. I'm excited to get started.
Good stuff, Brett. So, all right, before we get down to things, before we jump into today's topic, can you talk a little bit about your background and what led you to focus on working with business owners and entrepreneurs?
Absolutely. I spent several years in corporate accounting, and I shared a lot of different information with a lot of different shareholders. And I learned in those presentations that a lot of time my audience wanted to know one number, for example, net income or what's my total tax liability, without really understanding the overall health of an organization. And I enjoyed being able to connect answering their one question with maybe a deeper question that they should have been asking. So I wanted to take that idea of education and empowerment and push it towards business owners and entrepreneurs. That's really how we kind of built Luca Financial, and it's the foundation for a lot of how we work with our clients today.
So, tax planning and tax preparation are often treated like the same thing, Brett, but they're actually very different. What separates the two?
It's really about removing the element of surprise around taxes. So often I'll meet with new prospective clients and we talk through what happened last year. And most of the time I hear, I got my tax return the day before it was due. I was told I needed to write a really large check to the IRS. There was no time for me to plan or ask questions, so I just had to roll with it. Versus tax planning allows us to meet with a client or the taxpayer at several different touch points throughout the year. So in April of a current year, we're going to be meeting for that year moving forward. That allows us to plan. We're going to estimate what the total income is, what the total tax liability might be, and then say, hey, do you want to put some strategies in place to reduce that number? If so, we need to get started now. And that gives us 12 months effectively to start planning for someone's tax liability. So one, they just know about it, right? It's less of a surprise in the spring. And then two, if we want to reduce that number, here's some things that we can put in place to reduce your tax liability as well.
So why does waiting until tax season usually, leaves business owners with, far fewer options to reduce what they owe?
Yeah, that's a really hard concept for taxpayers to understand. Why can't I just go back and fix things? So there are several strategies that we put in place that really cannot be applied retroactively. They've got to be put in place and established, implemented by December 31st at midnight in the year in which they want to take advantage of the strategy. So when we talk about timing, it really does matter. The sooner, the better. There are strategies that can be put in place after the fact. So let's say it's April of 2026. We're filing your 2025 tax return. We're now 4 months into the new year. There are still some strategies that we can go deploy to reduce your tax bill, but the bulk of the real true savings comes when we can really put planning in place now in preparation for the current year. It really comes down to that midnight on December 31st rule that a lot of the tax strategies are dictated by.
So what are some of the biggest business or financial decisions during the year that owners don't realize can affect their taxes later on?
Yeah, there's a lot of them. So understanding your net income is really crucial. And a lot of times taxpayers look at their net income on a cash basis to say, I received this much cash, I paid out this much cash, what's my net? But then there's other taxpayers who also use accrual accounting. And so it depends on how you're telling the IRS you're filing your tax returns. And you can't just make that decision and change it every year. You've got to make it and stick with it. So once we have that foundation, then we need to know what's that true taxable net income, whether it be cash or accrual. If we can look at that all year long, that's the most important part. We see all the time cash basis taxpayers, meaning you're going to pay tax on the net cash you receive. So cash received versus cash paid out, that difference there. A lot of times we'll see cash taxpayers get maybe a large deposit into their bank account on December 31st in a year. And if they had been meeting with their CPA, they would know, hey, I really need to try to defer any cash receipts the last 2 weeks of the year. That's a simple one, rather than having payments come in those last 2 weeks. When you've been planning all year long and then you've got a surprise deposit hit your account, that can really cause some issues later on. And then also, really, it just comes down to simple cash flow. We want to look at strategies that, one, really don't affect your cash flow. Are there ways that we can get money out of your business account into your personal account without causing a strain on cash flow? And yes, there are certain strategies you can deploy that do that. But then also, for the taxpayer to understand, maybe there's some heavier strategies that produce larger savings that do require cash flow. They've got to go do an investment or set up some sort of fund to go get a reduced tax bill. And you need to plan for those, because that's a hard conversation to have when I'm talking with a client and I say, hey, I'm estimating your tax bill is going to be $43,000, let's say. If you put 20 grand into this investment, then I can shave off whoever, I mean, depending on what strategy we're looking at, we can shave off $10,000 to $30,000 of taxes depending on that strategy. And that's a really hard conversation for a client to have of, I don't have 40 grand to pay my tax bill, but I also don't have 20 grand to go put into an investment, even though I know I'm going to save so much more, because they just didn't plan. So we don't have that cash. So the biggest mistake I see is just this kind of turning a blind eye and a deaf ear to taxes. You've got to look at your taxes as you go throughout the year so you can plan.
So at what point does a business usually need more than just that annual tax filing and bookkeeping?
Yeah, absolutely. So there's two components here. Talking about business owners, we typically tell business owners that, let's say you've set up a side hustle and it starts to turn into something. When you have around that $70,000 mark of net income, so I'm going to look at gross receipts minus my business expenses and what's left over, let's say it's 70 grand. Once we hit that number is really when we need to start thinking about tax planning. When you've got income lower than that coming from a business, the cost of tax planning, additional tax returns, sometimes they don't outweigh the benefit. So that's a good marker on the business side. Once we really see about 70,000 bucks of taxable income is when I say, hey, let's start planning. But then on the other side of it, I've also got W-2 earners who aren't business owners, and maybe those high W-2 earners. Anybody really making about 250,000 and above on a W-2, there are some strategies that you can deploy as well. Not as many, not as exciting as on the business side, but those are pretty good thresholds where I would say, hey, this really makes sense for you to start looking at tax planning. There's a cost that comes to tax planning, and so that's where the benefit starts to outweigh the cost, I would say.
So, Brett, can you share an example of a situation where proactive planning significantly changed the financial outcome for a business owner?
Yeah, absolutely. I've got lots of those in its simplest form. Let's say we're going to talk about that taxpayer who's made about $70,000 of income on their side hustle. As it's traditionally reported on their tax return, it's included on your individual tax return, your Form 1040. But whenever you've got side hustle income, I'm going to call it side hustle or business income, on your 1040, it sits on what's called a Schedule C. And that's your small business where you're reporting your income and your expenses, what have you. So now I've got a net income of $70,000. And when I report income on a Schedule C, all of that income is subject to self-employment taxes. Self-employment taxes are made up of Social Security and Medicare. In total, it's about 15.3% of your income. So if I've got $70,000 of income coming through on a Schedule C, I've got an additional about $12,000 of taxes that I will be paying in addition to your federal income tax. So if I've got that same person that made $70,000 on a business and they're also making $250,000 on a W-2, they're going to have a marginal tax rate of 24, 27%. So I've got federal income tax of 24, 25%. And then I've also got self-employment taxes of 15.3%. So now I'm paying sometimes 40% taxes on those dollars. Whereas a simple change in how you report that income by making an S election, a lot of business owners have heard about making an S election with the IRS, reporting your income on a separate tax return altogether, that removes that element of self-employment taxes, because then we need to set up a payroll. So because we're able to make an S election and report that income on an S corporation tax return, now that $70,000 in year one is no longer subject to self-employment taxes. So that $12,000 of additional tax goes away. So that's big savings right there. Just through some easy tax planning where we need to set up some entity structure, that really will help reduce someone's tax bill. Other big items that I see are taxpayers just simply aren't taking advantage of the deductions that they're allowed as a business owner. We see a lot of Schedule Cs come through from new prospective clients, and I've got their, let's say they're a realtor, and I've got their commissions. It's $100,000 listed on their Schedule C, but then I don't really have any expenses associated with it. Maybe they've given me mileage or home office, and those are $2,000 or $3,000 of expenses. But there's other things that we can be looking at, like your cell phone, your home internet, the portion of that you're using for your business, any subscriptions that you might be using for your business, gifts for clients, equipment that you've purchased, depreciation on a vehicle. There's a lot of other expenses that can be added that a lot of clients maybe are scared to take of because they think they're going to get audited, or two, they simply don't know that they can be used as business expenses. And so that's probably one of the other biggest items is I've got all this income coming in and no one's trying to reduce the income by the expenses that they're allowed to take and eventually reduce their total taxable income, which reduces their tax liability.
So what separates business owners who consistently stay ahead and financially from the ones that who always feel surprised during tax time?
It's planning. That's really what it is. So I mentioned earlier, a lot of times we'll meet with new prospective clients and they don't want to talk about taxes because it's always that taboo subject. I don't understand it. It's just a surprise. I'm used to it. It is what it is. But if you take a break and look at your taxes, it's just like us as individuals. We don't want to look at our budget sometimes either. Like I don't want to look at how much money I made and how much money I spent, but you have to. So really enabling and empowering somebody to sit down and look at their tax situation is what makes such a huge difference. And for a taxpayer who's going to be new to tax planning, when they're able to look at their tax situation and then be able to identify opportunities to reduce their tax bill, that's what gives you that sense of euphoria that where before you didn't want to look because you were so scared. But now if you work with a tax advisor and they say, hey, pre-tax planning on calculating that you're going to have an estimated tax liability this year of the $40,000. But we're going to put some tax planning in place, and I've been able to reduce your tax bill all the way down to $22,000. So in your brain, you're thinking, I've saved $18,000. It's not all due today because I'm planning. So I'm going to make 4 payments of $5,000 a quarter. So then when I get to the spring next year and it's time to file my tax return, it's just a matter of compliance. My CPA is going to prepare my tax return. I've got no surprises because we've talked about it all year long. And I've made my quarterly estimated payments. So I just got to sign and file. And that's much less stressful than walking into your CPA's office, not knowing what to expect, and then just being surprised. Most of the time, that surprise is going to be, I owe money. Very seldomly are you getting a surprise that says, I'm going to get a refund, especially if you're a business owner. But having those conversations all year long is what really is going to separate someone who, one, understands their cash flow, but I would say just a really savvy business owner versus someone who's scared and doesn't want to look at it and decides I want to remain ignorant. That's where we see a lot of taxpayers run into issues.
Good stuff. Good information, Brett. Thank you so much. It was a pleasure.
Thank you. Thank you so much.
All right. That's it for today's episode of the Luca Ledger with Brett Arnold. If you'd like to learn more about strategic tax planning, fractional CFO services, or building a stronger financial foundation for your business, visit luca-fs.com. Thank you so much for listening. And don't forget to subscribe, leave a review, and share the show with another business owner who could benefit from the conversation. And we'll see you all next time.
Thanks.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.